Hey guys, so a deal has been struck, and there is an agreement between the Republicans and the Democrats about the debt ceiling issue. And today in the morning in India, we got the news that the issue has been solved, and a verbal agreement has been agreed on by both the parties, by the Democrats and the Republican. And then we saw both the sides tweeting on this. Uh, it is not so easy from here to see what will happen in the market. I think the sentiment in the market is as such that once the deal is struck, everything will be in a proper manner and the uncertainty would be over. But I personally feel that the market is not taking into consideration a big fact which is going to come into play in the coming days. And that has also happened in 2011. And now we will go and look at what really happened during that time. And then we could jump on to a conclusion that will this happen again? Do watch the video till the end because you will get a clear picture about what I'm talking about and what can be the effect if those things come into play. So let's go. Firstly, the debt ceiling issue is done. The main concern for me here is that there could be a bumpy ride from here. And there is a slight possibility that could happen. And I think if that happens, then we should be prepared to counter that. And our portfolios and our trading positions should be planned in that manner that if that event happens, then we will have something to make use of during that time. So let's go and let's see what I'm talking about. Firstly, deal done. Biden and McCarthy reached tentative US debt ceiling deal. Today in the morning, we got this news. Good news. And the market uncertainty about this is done. But don't think that this is the final deal. Once this is done, then this is just the final thing which is going to happen, because now after this, yesterday in the morning, we saw the US Treasury Secretary Janet Yellen come and say that the ex date has now changed from June 1 to June 5th. So not June, previously she said that it is June 1. Now she's saying that it could be June 5th, the ex date when the Treasury could run out of money. So now the Republicans, the leader of House of Representatives, McCarthy, has said that now on Wednesday, we will finalize all the written statements of this deal. Then we will send it to House of Representatives. And if there is any issue in the House of Representatives, I feel then that could also add volatility. But I think it's going to be a easy ride. There won't be much happening. People will say yes, vote for it, and then it will go to the Senate. And once the Senate says yes, it goes to Biden. Biden signs it, and then it is a formal agreement that the debt ceiling has been raised. So I don't think there will be a issue in these things, in these events. But I think there is something which the market is not considering, and I would like to show it to you. And this happened in 2011 as well. So let's go and let's see what happened in 2011. So in 2011, what really happened was, if you see in 2011, your S&P 500 kind of made a top in July 2021. Then S&P 500 fell massively. This is close to 20% fall, which we saw. Then it went sideways for a few months. Then it again tested the bottom. And this was the last time the bottom was tested. And then in that year, a great bounce came. And then S&P that year closed 1.89% higher for the year. But the way things had started, it was looking like it could be a 6-7% up year, and even 10%. But then once the debt ceiling issue had started, then there was a huge dip in the market. And you saw that in 3 months, the market kind of went sideways after the fall. And then there was a rise on the higher side, a strong bounce, which helped S&P 500 close 1.89%. Also to consider, from the top till the bottom, this wasn't exactly 20%, because if it is 20%, if the market closes from the top, which is the peak is this, and the bottom closes 20% lower, we say it is a bear market. But this 2011 fall wasn't considered a bear market because it never closed below 20%. It went close to 20%, but it never closed below 20% from the top. So for that reason, this was never considered as a bear market. But if you see, this is a huge fall that had happened in the market in 2011. Now, what we will do is, now we will see what happened to the different assets during this time. So what really happened from the top to the bottom, what really happened in S&P 500, that is the stock market of US, the index of US market, 19% fall. There was a 19% fall. The US VIX, the volatility index, shot from 18 to 48. Imagine that 18 to 48 rise because of this fall. That is a big fall, big rise. And then what happened to the bond yields? Bond yields fell by 125 basis points. That is 1.25% fall. That means the price of bonds went up because the yields came down. And why did the price go up? Because there was demand for bonds. There was flight to safety. People started investing money in safe haven assets. For that reason, there was a fall in the bond yields, which led to a rise in the price of bonds because bonds were in favor and bonds were in demand. And for that reason, people were parking their money into bonds. What happened to oil? People started to think that the demand for oil could get hurt. And what really happened? Oil came down and gold went up 25%. So all of these things say that in 2011, risky assets, people weren't demanding that, and safe haven, non-risky assets, safe haven assets went up. This is safe haven. This is safe haven. What is risky? Stock is risky. And oil, because demand was supposed to come down. For that reason, oil also came down. So everybody started to park their money into safe assets. This is what happened in 2011. Now let's look at the events, because this is the most important slide, I would say, of this video. So what really happened was that they said that Standard and Poor said that US debt on credit watch negative. So they had put the US debt on negative watch list. What really happened a few days back, last week, Fitch also said the same statement that US debt is on negative watch list for us. I'm not saying that now what they said is going to repeat. The events are going to repeat. But I'm just telling you that there is a similarity, that at that point, S&P also said this, that we are placing US debt on negative watch list. And this time as well, Fitch has come in and said that we are putting on negative watch list. They are not downgrading, but they are keeping in negative watch list. So there are credit rating agencies which tell you how credit worthy a country is, or how a company is. The bonds of a country or a bonds of a company, they tell you how credit worthy they are. There is Moody's, there is Fitch, there is S&P. So these organizations tell you how credit worthy the bonds are. And then what really happened in 2011? After that, there was a kind of a flat market. Okay. But really look at what happened. August 2nd, Congress signs a deal narrowly avoiding a default. So this happened approximately 72 hours to 48 hours before the US was going to default on its debt. And what really happened? If there was a solution to this issue, then why was there a huge fall in the stock market? Why did S&P 500 fell? Everybody would have thought that it is a done deal and now the market would just go up. But what happened? Stock market just fell. Why? So the event, what really happened at that point, after 3 days when the issue was resolved, what really happened was S&P 500 downgrades the US debt for the first time. I don't think so this is going to happen this time. I personally believe that nobody's going to downgrade US debt, and this event won't happen the same way it happened in 2011. So I don't think so this will happen. If this happens, then it is done for sure that there will be a kind of a crash kind of a scenario in the market, but I don't think so this event will happen. There are some other issues that could happen, but not this one. That's my personal belief. And what really happened? Then from 2nd August till 8th August, in 6 days, S&P 500 fell very big. We saw a very big fall in S&P 500. And the fall was kind of huge. And if you see, it was trading around 1300 and then it went towards 1100. So that is a huge fall. And what happened? August 8th, S&P closes down over 6% following the historic downgrade. So kind of in 2-3 days, we saw a 6% fall. So this shows that once the deal is done, that doesn't mean that everything is very good or everything is rosy. Don't take it that way, because there are some issues that could come. And now let's see what issues am I talking about. And those issues the market could start considering from here. So let's go and let me show you the issues. So the risk ahead. So there is an article by Reuters, and in that I read that So for example, why is the debt ceiling being raised? The government doesn't have money or cash to pay off its debts or expenses. So if it can't do that, then it will have to fill up its account again. And how can it fill up its account? How can it issue more debt? So what they will do is they will raise the debt ceiling. And once they do that, then they will issue more bonds so that the balance, their account balance goes up. Right now, for example, that they don't have cash. So now they need to fill up that cash. Companies also do this. To fill up the cash they have, they can issue debt. And now what the US government is also going to do, they are going to issue nearly 1.1 trillion in treasury bill. This is the short-term bonds over the next 6 months. That is a huge number. 1.1 trillion in treasury bills over the next 7 months. And what is happening right now is interest rates are quite high. So the issue of these debts will be at a higher interest rate. And then what would happen? People will think that the interest rate they're getting on these bills is really good. And then they will think, let's buy this because it has a lower risk, because it is US government bonds, it has a lower risk, and let's just buy this. And instead of putting anywhere else, instead of putting the money in the banks, let's just buy this. So what will happen? The money will be pulled out of bank deposits. So currently the interest rates are quite high. This will deplete bank reserves as deposits held by private companies and others move to higher paying, because higher paying is the interest rate of the bond, relatively more secure government debt. So the money would come out of banks, and then where will it go? Into these bonds which are going to be issued. And this will lead to, already there is an issue because of this, because the interest rates are quite high. The banks deposits outflow is at a higher level. Money is coming out of banks. Deposits are coming at a low, like people are not depositing money in the banks. So this will put more pressure on liquidity for the banks, cash available for the banks. And this is a big issue that is coming ahead. And I think this is a big issue. Already there is risk in the regional banks. And once there is these bonds that are going to be issued, then there will be more risk in the economy. And this will show you that the market is at a risk, and there are chances that more banks could be at risk after this happens. So now, what should be our plan of action? Before we go into that, we have to look at what is the market predicting, what is the probability that the next Federal Reserve meeting, which is on 14 June, what could happen there? So in the past 1 week, there has been some data points which have showed that the economy is still strong. And then the market, till last week, we were saying that there will be 82% chance that there will be no change in interest rates. But now that number has come down to 35%. So the market is saying that the probability of a no change in interest rate on 14 June has come down from 82% to 35%. And a 25 basis rate hike, a 25 basis point rate hike, that is 0.25% interest rate hike. 1 week back, the probability of this happening was only 17%. And now it has come up to 64.2. And what really happens here is that the effect of the interest rate takes time to be visible into the economy. And sometimes the current effects which we are seeing of interest rate hikes is the effect of that hike which we had done 5 months back or 4 months back. So the effect of the last 4 or 5 rate hikes is still to be seen in the economy. That's what the economists say. And if you do another hike, then it adds to the economic risk, because the effect of the last 3-4 hikes has still not been visible in the economy. And without that, only you've seen the regional banks come into pressure. So I'm just telling you what the economists feel. And I'm not trying to tell you that we are not in a good situation, the economy is too bad. I'm just trying to give you a clear picture. If there is another rate hike, it will add to the economic risk. And whatever the Fed is expecting that there will be a soft landing, I don't think so that scenario will play out. And the market right now is not realizing that. And the market and the stock market is just going higher. Even if the dollar is going up, the dollar is gaining strength. The stock market is also going up, and NASDAQ has been on an excellent run up because of a few results. So if the scenario plays out, what should we do? If there is a risk scenario, what should we do? Let's look at that. So what would happen is, now that the market has started to see that the economy is strong and there will be a soft landing and there will be no issue in the economy is strong, we saw that gold had started to come down and it went up, gave a strong run up when SVB crisis had happened. Now, in the past few weeks, it has come down. This is dollars. So per per ounce, the price is 1946. And in India as well, it has come down to 59,500 for 10 carats. So for 10 grams, that is the price which is going on in the market, approximately that price. So if there is a risk event, if all these play out, for example, if people think that a 2011 kind of a scenario could come back again, then gold will go up. And gold is placed at a level wherein I feel it is good to add some exposure to gold because it has given a good dip. And there is a likely chance that we could rise higher from here. So gold might give you a good return. If the scenario which I'm talking about, the risk scenario in the economy happens, then gold is one that you could look at. Then the second one is bond yields. So right now, what is really happening is that people have started to think that there is a risk to hold US government bonds and US could default on its debt. The debt ceiling issue could not be resolved. There is a likely chance of that happening. So what really happened were people were not buying US government bond. Instead, they were selling it. And when they are selling the bonds, the price of that bond comes down and there is an inverse relationship with the bond yields. So if the price is coming down, then the bond yields of the bond are going higher. And because of this, we've seen that bond yields have risen quite fast. And what could happen if there is a risky scenario, then bonds could come back into demand, the prices could go up and yield will start to fall. If this starts happening, then I would say these bond yields will start to come down if there is a risky scenario in the economy. Now, how could a person who's trading in US could take exposure to this? What you could do is you could buy TLT. TLT is the US government bond. So you could buy the TLT. And TLT is kind of trading near the support level from where it rose last time it tested this level. And on Friday also, we saw a bounce in TLT. So if bond yield starts to come down, then you could see that TLT could go higher and at least test 108 if the risky scenario which I'm talking about, which had happened in 2011, had also happened. And mostly, this is a good play which is going to help you if there is any risky scenario, then due to any bank or due to the debt ceiling issue, then this could be where the money would flow into and a lot of people would be buying TLT. Now, after this, Russell has a higher exposure. So the ETF for Russell is IWM. And the ticker for this ETF is IWM. And I would say it is better to play Russell than S&P 500. If a risky scenario plays out, then stocks will fall and your Russell and S&P 500 could come lower. But I would say better than S&P 500, it is better to play Russell because Russell has a higher exposure to regional banks, and regional banks are the one which will face the biggest issue, and regional banks are the one which will have the highest exposure to this news. And Russell has a higher exposure to regional banks than S&P 500. So IWM is the one you could look at, and then I think a test towards 162 is likely. If the risky scenario plays out, then a fall towards 162 is likely. That's what I feel. And I would like to give you a disclaimer that this is just for you to learn and understand how you could think and what scenarios could play out if what we are discussing is shaping up and a risky scenario happens in the economy. Then this is how you could play this market. And this is only for educational purposes. Don't take this as a financial advice. Now, if you're someone who is trading in the Indian market, so I would say better than Nifty, it will be better to trade Bank Nifty, because if US banks face any pressure, then that will also lead to a pressure in Indian banks. And I feel the reversal sign in Nifty will come, Bank Nifty would come when Bank Nifty goes below 43,500 and gives a closing. So if that happens, then I think there will be a risky scenario here as well. And we could see a profit booking kind of a scenario in banks because of the pressure in US banks. So the strategy which I'm looking at is June end expiry. I would like to play a fall in the market through a bear put strategy. And I'm not going to take that higher risk because this scenario playing out has a very low probability. So a scenario which has a very low probability, I don't want to take that big risk. So to lower down the risk, you should also sell puts. So what I'm doing is buying 43,500 June expiry put option and selling 43,000 June June expiry put option. So both are June expiry. The buying is 43,500 put option and the sell is 43,000 put option. The maximum profit I could make is close to 9,000 and the maximum risk is close to 3,500. The probability of winning here is low because the probability of this scenario also happening is quite low. Break even is 43,350. If that scenario plays out, then 1.5% is 1.5% fall is quite likely, and that won't be really hard, won't be that hard to come. So I would say that be cautious in the market and just look and observe all these charts. And the reason I've told you that this could come into play, just observe those sectors, observe those charts, and I would keep updating you guys on my various social media channels and see you in the upcoming videos. Bye-bye. Take care.